Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu, 4 o'clock in New York. It is Wednesday, November the 4th, 2015, and this is the daily report for gold and silver. We have a continuation of this sell-off that has just been so prevalent in the precious metals markets, with gold trading off almost $10 on the day. Right now, $9 and change at 1108.50. That is just off of the low at 1106.58 and the high 1122 and change. First chart I want to take a look at today, because I think that we are absolutely getting near a potential bottom in the market, historically speaking, that is, as this market drifts lower and drifts back to that territory of about 1100. Good news, bad news scenario. Good news is I think that we'll probably see this market bottom outright in here, and I'm basing that on some historical data. Good news. Bad news is it really negates the majority of any kind of a bullish model that we have. However, there is a small glimmer of hope in that 78% retracement level, and we talked about this a little bit yesterday. We haven't really brought it up before because genuinely I didn't expect the market to sell off this hard. I thought we would hold at different levels, and we absolutely didn't. The 61% retracement level, for example, well, that's just a couple of days ago that we saw that. We broke through the 50. Now, the 50 I never really regarded with any kind of strength, but I did look for a potential cease to the sell-off early on when the market hit this 38% retracement level, and that was based on a couple of things, historically speaking, and that was these series of tops here. Now, as I said, that absolutely did not hold. But when we look at our current market as it sits, we have some really solid support right at about $1,100 per ounce. Last time the market, the previous low, and we're pretty much equal with that low right now, but the previous low was roughly in this area. In fact, if we take a look at our cursor, we'll see that this low here came in roughly at 1104. Our low today, 1105. So we're very, very close to a point where I really believe at this point now we want to start looking for bottom activity. Now, we've talked about that over this last week, what we're looking for, whether it's a piercing line or engulfing bullish. There's a multitude of candlestick patterns that can appear that would signal a potential conclusion to this correction. But this correction has been steep and it has been quick. There's no doubt about that. So as I said, we are certainly at a point that we want to look for potential bottom signals in the market. And one of the tools that we have been using to really ascertain strength or magnitude of the current trend, this trend obviously being down, is by the use of Japanese average charts. By identifying a candlestick and creating it from a midpoint rather than an open, low, high close, it gives us a different sense or feel for the market. We've talked about this over the last couple of days. The things that we look for that give us a indication based upon Japanese average charts in terms of the strength of this trend are still absolutely, and this is a daily chart by the way, but are still absolutely showing us that this trend has not waned considerably. It has not really lightened up that much at all. And in terms of looking at different points in the market and giving you an idea of what it is we're looking for, first realize, as I said the other day, the major caveat of an average chart is it's going to lag behind everything else. So by the time this is telling us that the market is about to flip, we will have gotten all kinds of signals from many of the other studies that we do. Fibonacci and candlesticks will always leading indicators as opposed to a lagging like this. Now, you can see body size today is quite large. No doubt about that. You've got a large size candle. You've got the absence of the upper wick, which means that there's continued selling pressure. And to give you an idea of what we are looking to see, take, for example, this sell-off. You can see that on the sell-off, you get a really acceleration right as the market breaks below, call it 1147. But as it bottoms, you can see that the body size gets very, very small, and these upper wicks begin to appear. That tells you that the trend, this downtrend that was here, is now weakening. Sometimes you will see it simply go into smaller candlestick sizes, and then you get your flip that green, so you're not getting the consolidation as you do here, but you'll also get scenarios in which it stays not only red, but a large body size until the actual flip point itself. This would be a rather large up day, and look at the highs and lows. But nonetheless, you really didn't get any indication on this candle that the market was about to pivot. And so as soon as we're seeing some sort of green in the market, that will give us an indication, of course, with the Japanese average charts. So traders, in as much as we are now in an area that we really want to look closely for signs of bottom activity, the facts are that we've received absolutely no technical evidence that this correction is concluding. And we talked about that the last couple of days. These are areas that we want to look at, but criteria has to be met. Obviously, that criteria has not been met over the last couple of times we've gone through various Fibonacci retracement levels. On this weekly chart, the one thing that's evident is considering the price move, and this is only Wednesday, but the price differential between where the market opened and where the current is, of course, it could come back up and be a much smaller red candle by the conclusion of the week. But as of right now, it exceeds the size of the prior 2 weeks substantially. We can also see, and this was a key number that we talked about, which is the 78% retracement level, which sits at around, call it 1092. You've got this whole series of bottoms here. That would be a logical point to look at. If in fact it doesn't hold 1100, I would definitely expect it to absolutely hold 78% in terms of a retracement. And that's also a line in the sand, as we've talked about. And the line is whether or not we can maintain any kind of a bullish model and make the assumption that what we're looking at is a correction rather than a return to a bear market. And so to do that, of course, what we look at is the magnitude of the correction. And when we look at this point right in here, as you can see, this is a fib retracement, as we've gone through before, coming from this bottom right in here, roughly 1076 up to 1192, and a move to, on this particular chart, it comes in at 1101, but that comes in at a 78% retracement. And that's the area that we'll look at, because there we have a multitude of information that tells us that this was a conclusion of a wave. And so that puts some major support in that area. This a little bit more minor, but nonetheless, we do have a potential double bottom right in here, almost a triple bottom, but this is a lower low. There's no other way to look at it. But most importantly, that we are absolutely within striking distance, I believe, of the conclusion to this current correction. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow on Thursday for another daily update and review. Bye-bye.